Are you aware of the format or the structure of the balance sheet? If yes, do you understand the dynamics behind it? Then this is the right video for you to watch. Hi, I'm Saujanya and I coach corporate executives who want to accelerate in their careers, especially in the finance domain. And I also coach students to understand finance in the most practical way. Coming back to our video. We were doing an induction program in an entity where we were explaining to the new hires or new joinees about assessing the financial position. And that particular session inspired us to do a video series to understand balance sheet and the financial position in the most practical way. To begin with, there is a particular format or a structure in the balance sheet which is all given to us by Schedule 3 of the Companies Act. And it has a specific mention of sources of funds, which is also called as liabilities to begin with. Now we can have this balance sheet in the horizontal format like we all have studied in the academics, where liabilities and the assets are shown one beside the other. Or we can also look up to an annual report and understand the structure of the balance sheet, which is presented in the vertical format, where sources of funds or the liabilities are shown initially, followed by the application of funds or the assets. The first item under the sources of funds or the liabilities would be the internal liability or the internal source, which is known as capital, which is largely given by the shareholders. This would be the initial amount introduced by the owners, because the shareholders are also known as owners. The second segment in the sources of fund or the liabilities would be retained earnings and the reserves. Here, we need to understand retained earnings. Retained earnings, as the name suggests, is the earnings which is the accumulation of the company's net gain and something which is accumulated over a period of time. We also understand something on the reserves. An entity would have specific resources or reserves which is earmarked and kept separately, which are known as specific reserves, or certain resources or reserves which is kept for a general purpose known as general reserves. Put together, that is capital and the retained earnings and reserves, put together would be known as equity or net worth. Both are supposed to be the internal liability in any organization. The third most important sources of funds would be loans. Loans are the external liabilities where money is sourced from borrowed funds from banks or financial institutions. All of these three are long-term sources of funds. The fourth in the format would be the current liabilities. They are largely sources of funds on a shorter duration. Means this has to be settled within 12 months. So the entity, once they get the funds, they have a time duration to settle this. A classic example for a short-term sources of funds would be accounts payable, or all the credit which the entity gets from their vendors when they procure resources for their manufacturing or retailing or servicing activities. This would help us to understand the structure on the liability side or the sources of funds. So the entity would accumulate or generate or get those resources to run the business. All of this is applied, which is known as application of funds, which is known as assets. The first and the foremost application of funds, what we would see, is fixed assets. Fixed assets are resources which are held by entity to generate revenue. So, a classic example what we can take in this scenario as machinery. Machinery would be understood as the set of resources which are used for generating those products, and those products are eventually sold. So asset, a machinery, are resources which are held to generate revenue. Once we understand about fixed assets, the amount of fixed assets which is held by an entity can be of various categories, which are tangible, properties, plants, which can be seen and kind of felt. The other one is intangible fixed assets, would be largely goodwill or patents, which are not in the tangible format. The second most important application of funds would be investments. They are nothing but entities invest their surplus money into a revenue generating mode, which can be fixed deposits which can earn interest. These fixed deposits are those deposits which are held by entity, which can be categorized or present as a cash equivalent itself. But if the fixed deposits are held for more than 1 year, or it is a non-current investment, they can be categorized for a long-term application of funds in the form of investing the extra surplus money. The next important segment in the structure of the balance sheet would be current assets. Current assets are all of those assets which needs to be realized into cash or into cash and cash equivalent, all into money within 12 months. Classic example can be inventories or any of these accounts receivables which have to be converted into money within 12 months. This would help us to understand the entire segment or the structure of the balance sheet. I hope you've liked this video. If you've liked this video, do share and comment and subscribe to our channel for more such updates.